All right, here we are with the allowance method problem or example. So we're going to be doing the journal entries for this problem. It's multi-year, so we'll get to that in a minute. But let's go ahead and begin. December 1st, Juliet Company provided consulting services of $40,000 paid on account during 2000, whatever the year is. So they didn't pay it in cash; they put it on account. So we know that our debit is going to be accounts receivable for 40,000. So December 1st, accounts receivable for 40,000. And then we've done the work for it, so we know it's going to be revenue. So we'll credit service revenue for the same 40,000. Now, if we're going to put that into our visual aid of the folders that we saw in the previous videos, we have our AR folder, and we're going to add $40,000 to that. Okay, so now we're good there. Let's look at the balance sheet right now. The balance sheet, as it sits right now, we would have cash and all that other stuff, but eventually we would see AR of 40,000. Okay, as that sits right there, we're telling our investors we're going to get $40,000. We know that's not going to be the case, but let's keep moving forward, and we'll kind of affect it here in a minute. All right, December 15th, Juliet Company collects $15,000 cash from transactions paid on account. So they're paying off a portion of their account. So we're getting cash. So we will do December 15th, debit cash for 15,000, and then also credit accounts receivables because we're taking it off of their account for 15,000. Now, if we do that, we're going to take 15,000 out of our envelope. So take 15 out. That leaves us with 25. So our balance sheet would be AR equals 25. All right, the next one. December 31st, Juliet Company estimates that $500 of the accounts receivable will be uncollectible. So if you think back to what we were talking about when the stages of the allowance method, this is the I think stage. This is where we're saying, I think this is not going to happen, or I think we're not going to get this. So we need to go ahead and expense it and then put it into our contra account to just kind of hold it there until we actually know. So December 31st adjustment, we're going to expense it. So our debit is going to be bad debt expense of that 500. And then we're going to put in that holding account of allowance for doubtful accounts for the same 500. Now, what does that mean? Well, within our big envelope, we're going to put a smaller envelope that's going to be called ADA. And we're going to take a portion of that 25,000 and put it into that smaller envelope. So we'll take 500 of it, put it in the smaller envelope. Now, if you look at the entire AR envelope, it still adds up to be 25,000. We just broke it into two pieces. So we're going to take this portion of ADA, put it on our balance sheet as a negative number. And what that's going to do is if we subtract the two, that's going to give us our net realizable value of 24.5. Now remember, net realizable value is the total realizable cash value. So this is the total cash value. This is really what we think we're going to get. And that's the first year. So now let's go into the next year, the following year of transactions. All right. So 3.1, which is the I know section, it says after multiple attempts to contact customers, Juliet Company determined that $240 will not be collected and elects to write off the account. And the write off portion lets you know that this is the I know. We're getting rid of it. We're taking this $240 that somebody owes us and we're ripping it out of our books and throwing it in the trash, essentially. So we're going to take it out of everything. First place we're going to take it out of is the ADA because we put the 500 there for specifically this purpose. So we'll take out $240 out of ADA. So we're going to debit it because remember it's minus plus. So 3.1 allowance for doubtful accounts of 240. And then we're also going to take it out of our AR. So we're going to credit accounts receivable for the same 240. Now, what does it do to our envelopes? Well, we're going to take 240 out of the 500, and it's going to completely come out of the entire envelope. So now if we add up our AR envelope, it's the 24,500 plus the 260. That's going to give me 24,760. My ADA account is 260. Change that. Now if I subtract those two, my net realizable value is still the same because remember that's the whole purpose of the ADA is to just make sure that we're showing exactly what we think we're going to get. All right, that takes care of the I know. Juliet Company provided consulting services of $60,000 paid on account during 2000 of the following year. That was April 1st, so we need to do that. April 1st, accounts receivable of 60,000, and then credit service revenue of 60,000. All right, let's add that to our main folder. So that'll be 84,500. Let's affect our balance sheet now. it is going to be 84,760. And if we take away the 260 again, that's going to give me 84,500 as my net realizable value. All right, the next one, it says on 4/30, Juliet collected $25,000 cash from transactions paid on account. So we are getting cash, so we need to debit cash of the 25,000, and then we're going to credit accounts receivable of that 25,000. Okay, so we need to take it out of our AR folder. So we'll take 25,000 out. That leaves us with 59,500. We need to affect our balance sheet, so it's going to give me 59,760. Still having 260 in ADA. That will give me a net realizable value of 59,500. All right, the last one says Juliet Company received $140 as payment for the accounts previously written off. So back on March 1st, where we said that we wrote off 240 because we did our due diligence, we contacted them, and they just said they're not paying. They ended up sending us a check for 140. So this is our uh-oh step. This is where we say we made a mistake. We prematurely wrote something off that we shouldn't have. So first thing we need to do is, well, it's currently sitting in the trash can, so we need to put it back on our sheets. So we do the reverse of the write-off. So 5/2, we're going to debit accounts receivables for that 140, and then credit ADA for that 140. That takes it out of our trash and puts it back to where it was. So again, take it out, put it back into ADA. By doing that, now our total AR is the 59,500 plus the 400, so 59,900. Our ADA is 400, so we take out 400. Our net realizable value is still the same. And then we get it in cash, and we take off our books correctly. So we would do debit cash of 140, and then credit accounts receivable for the same 140. That takes care of the uh-oh step. We take it out of our AR folder the correct way, which takes 140 out of there. That leaves me with an AR balance in total of 59,760. My ADA is still the same, and my net realizable value now is going to be 59,360. And that is how you do the most basic form of the allowance method. And in the next videos, we're going to be talking about how do we calculate that number. So hope this made sense to you. Y'all have a good one.